Why traditional bank capital is not required. A modern framework for residential acquisition. 1. Understanding down payment assumptions. The traditional belief that residential acquisition requires a 20% down payment remains one of the most persistent barriers to entry in modern housing markets. Yet contemporary lending structures reveal that this threshold is neither legally mandated nor financially necessary for most borrowers. Federal programs such as FHA financing permit acquisition with 3.5% down, while conventional lending often begins at 5%. These lower thresholds shift the central question away from how much must be paid up front to how rapidly property appreciation outpaces the cost of mortgage insurance. So what does that actually mean? It means that delaying purchase to save 20% often results in paying more due to market appreciation exceeding PMI costs. Footnote: down payment standards are policy choices, not legal necessities, and lower thresholds accelerate buyer access to appreciating markets. 2. Inspection standards and risk allocation. A comprehensive inspection protocol remains indispensable in transferring residential real estate. General inspections reveal structural or functional deficiencies, yet they routinely exclude systems such as HVAC performance, septic integrity, or well capacity. These omissions expose purchasers to undisclosed future liabilities. Effective due diligence, therefore, requires targeted inspections beyond the general survey. The purchaser retains the right to request remediation from the seller, reallocating risk before closing rather than bearing its full cost afterward. Footnote: inspection-driven negotiations shift latent repair liabilities from the buyer to the seller before contractual finality. 3. Title assurance and encumbrance protection. Title insurance remains one of the most critical, misunderstood, and underutilized protective instruments in real property law. A deed conveys ownership. Title insurance preserves its integrity by shielding the buyer from unresolved liens, judgments, or encumbrances. In jurisdictions where lenders require simultaneous issuance, the purchaser benefits from institutional scrutiny that ensures the conveyance is free of legal defects. Failure to secure a title policy exposes a purchaser to post-closing claims that could impair possession or require substantial legal defense. Footnote: title insurance prevents post-transfer claims from disrupting ownership or imposing unanticipated financial burdens. 4. Maintaining financial stability during underwriting. Mortgage underwriting requires financial consistency. After conditional approval, any new credit obligations, cash withdrawals, or discretionary purchases can reduce credit scores or alter debt-to-income ratios. Because lenders conduct final credit checks prior to closing, such financial changes can disqualify an otherwise approved borrower. So what does that actually mean? It means that financial stillness, not activity, is the legal and strategic requirement between approval and closing. The cost of an ill-timed purchase can be the loss of the home itself. Footnote: stability during underwriting ensures the borrower continues to satisfy risk ratios required for loan issuance. 5. Boundary verification and property encroachments. A survey is not optional. It is a legal document establishing metes, bounds, and precise territorial rights. Relying on fences or mowing lines, as many do, creates exposure to encroachment disputes and potential title litigation. Reviewing and physically walking the survey during the due diligence period ensures that no structures, driveways, sheds, or neighbor improvements lie within the property lines. Discrepancies discovered post-closing become the buyer's burden. Discrepancies identified beforehand remain the seller's obligation. Footnote: survey analysis prevents boundary disputes and enforces accurate conveyance of legal property lines. 6. Insurance claims history and environmental risk. Insurance carriers maintain searchable claim histories for each property, revealing past fire, lightning, flood, or structural claims. These prior claims influence premium pricing and disclose risks unseen during inspection. Additionally, flood zone classifications A, B, or C determine whether insurance is optional or mandatory. Even in lower risk classifications, historical flooding patterns, not FEMA maps alone, determine true exposure. Reviewing both claim history and flood zone data prevents assuming hidden long-term risks. Footnote: prior insurance events and flood classifications materially affect long-term risk and premium obligations. 7. Seller-paid closing costs and negotiation strategy. Sellers are permitted to cover buyer closing costs, often totaling 3 to 4% of the loan amount. Although this reduces buyer cash requirements, the financed principal increases accordingly. The legal and financial strategy is not to avoid financing costs entirely, but to optimize liquidity at closing. The negotiation hinges on recognizing that the seller's concessions substitute for price reductions. So what does that actually mean? A buyer with limited liquidity may gain access to a property that would otherwise be unattainable. Footnote: seller-funded concessions shift upfront costs into the loan structure, preserving buyer liquidity. 8. Payment impact analysis and practical affordability. Negotiations often fail because buyers focus on large numerical differences rather than monthly payment variance. A $10,000 change in purchase price equates to roughly $64 per month at current interest rates. Understanding this distinction enables rational negotiation grounded in affordability rather than sticker shock. The question becomes, does a minor monthly variance justify securing the better property? Footnote: translating price changes into monthly payment differences creates clarity in buyer affordability calculations. 9. Public records review and litigation screening. A simple search of the municipal address can reveal prior lawsuits, property disputes, unpermitted repairs, flooding incidents, or code violations. Because these documents are public records, they provide insight unavailable from agents or inspectors. This step prevents inheriting unresolved disputes, or worse, purchasing a structurally or legally compromised property. Footnote: public record searches expose historical disputes or defects not revealed through inspection or disclosure. 10. Neighborhood, school zone, and quality of life factors. Legal acquisition is only one dimension of residential suitability. Conversations with neighbors reveal lifestyle, environmental, and community dynamics not captured in listings. School zone assignments significantly influence long-term desirability and future resale value. Due diligence must therefore extend beyond the legal condition of the property to the practical realities of the surrounding community. Footnote: community and school zone assessments determine long-term satisfaction and property valuation stability.